Rarely does a regulatory change in a notoriously opaque shipping industry attract the attention of the global oil market. The IMO 2020 regulations will have implications across the barrel. So what is IMO 2020? Why is the global oil market worried? How will shippers react? And what will be the implications across the global oil market? IMO 2020 refers to a regulation enacted by the International Maritime Organization, which is targeting sulfur content in marine oil. This is mainly due to human health and environmental concerns. Sulfur limits are in place for other fuels, and the maritime fuel oil will be brought into line with these regulations. From 2020, sulfur content in marine fuel will have to drop from 3.5% to 0.5%.
So the oil market is worried about these regulations for a few reasons. So high sulfur fuel oil, the marine fuel that the IMO is targeting with these regulations, is essentially a waste product from simple refining processes. Current demand is around 8 million barrels per day, of which the shipping sector constitutes 4 million barrels per day. So although it is a waste product and sold at a discount to Brent, HSFO is a key part of refining economics. So the big worry is, if demand for this product does drop, refining economics will also be negatively affected. Simple refineries will have to turn to lighter and sweeter crudes to minimise the production of high sulfur fuel oil. Now this will have the impact of bidding up the price of benchmark grades such as Brent and WTI, which are lighter and sweeter. Meanwhile, shippers will have to switch to middle distillate-based fuels, which will also have the impact of increasing the price of benchmark grades. The final point worrying the market is the fact that neither shippers nor refiners have been investing proactively, nor broadly entering 2020 unprepared for the regulatory change.
Shippers can comply with 2020 regulations by either going for marine gas oil, ultra-low sulfur oil, scrubbers, and they could even go for LNG, but it's still at an immature stage. When it comes to ultra-low sulfur oil, the main problem users will face is that the fuel oil is a blend, so unless they're taking a regular route calling at the same ports, they will face problems finding a consistent grade. Marine gas oil is consistent but will be priced well above HSFO levels. As for scrubbers, one has to calculate carefully the cost of installation, the cost of maintenance, and the time spent dry docking. A potential future uncertainty for scrubbers is what happens if new legislation comes in targeting a different emission, such as nitrogen oxides and carbon. It is unlikely that the scrubber will still be fit for purpose. On the bright side, by using a scrubber, one will be consuming cheap HSFO. So what are the pros and the cons of installing a scrubber? From a ship owner's perspective, you would not be very incentivized to install a scrubber. After all, you'll be responsible for the maintenance of a scrubber, which is an extra layer of complication. The ship owner would rather that the leaser opts for marine gas oil or ultra-low sulfur fuel oil. Meanwhile, the company leasing the ship would rather only have to pay for cheap HSFO rather than the more expensive MGO or ultra-low sulfur fuel oil. Reviewing various shipping response to scrubbers shows limited adoption by the majority of segments. Only cruise ships have shown willingness to install scrubbers prior to the 2020 deadline. This is due to the better financial health of this segment and the difficulty the cruise segment would have passing capex costs onto the consumers.
Limited scrubber adoption and the incompatibility issues with ultra-low sulfur fuel oil mean that the main demand shift will be from high sulfur fuel oil to marine gas oil. So we estimate the current marine fuel market at 3.8 million barrels per day of high sulfur fuel oil and 1.3 million barrels per day of marine gas oil. There are very small amounts of ultra-low sulfur fuel oil consumed, but they're not a major component of the current demand picture. By 2020, we expect the regulations to impact a significant volume of high sulfur fuel oil demand, and we expect the final demand to rest at 1.5 million barrels per day. We expect 1 million barrels per day of additional ultra-low sulfur fuel oil demand, and then finally the biggest shift will be from high sulfur fuel oil to marine gas oil, which we expect to increase from 1.3 million barrels per day to 2.6 million barrels per day. shifts in demands for fuels will cause major dislocations in product pricing relationships. We expect the main changes to occur by the second half of 2019 as stakeholders gear up for the regulatory change. So we've reviewed the historical spread of high sulfur fuel oil to marine gas oil at various Brent prices. So what we see is that the majority of data points lie on one particular trend line, with a few separate other data points lying on a higher trend line. So when we look at these data points on an annual basis, the vast majority of points on the higher trend line are from 2008. So 2008 we think will be a good proxy for the pricing relationships that we'll see in 2020. So the oil market in 2008 was characterized by extreme middle distillate tightness caused predominantly by very late cycle economic growth. So with the majority of shippers moving to marine gas oil, a distillate-based fuel, we expect a similar relationship at different Brent levels. So using the 2008 trend line as an approximation for our Brent price forecast for 2020, we end up with a spread at around $410 to $420 per tonne. This is currently around $150 per tonne, higher than the current trade-in price. So this is likely to be an extraordinary spread compared to historical levels. So when we look at the spread, it's only 2008 in the last decade where the spread has reached above $300 per tonne. It's traded far below it for the majority of those years. So we do expect that the regulatory change is going to have a profound impact on product pricing relationships in 2020. The spread between marine gas oil and high sulfur fuel oil is likely to be extraordinary when compared to historical standards. So we're now going to look at the impact on crudes and crude flows. So there's no doubt that as refineries move away from high sulfur fuel oil, they'll have to change the crude slate to be lighter and sweeter. This is going to have the impact of widening the light-heavy spread. So we've modelled the Arab light and Arab heavy spread as a proxy for a generic light-heavy spread against the high sulfur fuel oil MGO spread. And what we see is that when this spread is very, very wide, the product spread, it incentivizes refineries to make distillate at the expense of high sulfur fuel oil. And what happens is that this light heavy spread opens up. So we do expect this process to occur for the 2020 regulations. So we also expect crude flows to change. The US is currently a major producer of light sweet oil, and the refineries in the US have been taking more and more of this due to the competitive pricing of domestically produced US oil. US refineries are relatively complex compared to other refineries globally. And this means that as heavy crudes are discounted, these heavy crudes will flow to these refineries as they can upgrade heavy crude into more valuable products. So we'll likely see light sweet oil being exported in greater volumes from the US as the US refineries take more heavy sour crude. So we expect US exports to be consistently above 3 million barrels per day by 2020 to deal with this additional demand for light sweet crude from simple refineries globally, and also the changing crude diet of the US refineries. So there's no doubt that the IMO 2020 regulations are going to have a major impact on a lot of stakeholders in the oil market. So as soon as the spreads open to this level, all stakeholders will act to narrow them once again. So we expect shippers to rush to install scrubbers and refineries to optimise their processes and crude slates to minimise the production of high sulfur fuel oil and encourage the production of middle distillates. With both sides incentivised to invest CapEx to capture some of the wider spread, we expect the shorter cycle CapEx investment, namely shippers installing scrubbers, to be the dominant move and the dominant way that the market reaches equilibrium. So constrained dry dock capacity could be a limiting factor in this scenario, with the rate of installations relatively fixed around 6,000 to 10,000 per year. So although the spreads and the crude pricing dislocations will be relatively transient, the exact longevity depends on numerous moving parts which will become clearer in the next year or so. To sum up, the main winners of the IMO 2020 regulatory change will be the complex refineries able to upgrade high sulfur fuel oil into more valuable middle distillate products. Shippers who have installed a scrubber prior to the deadline will also be advantaged as they'll be able to run cheaper fuel. The losers will be simple refineries who have to run a lighter, sweeter and thus more expensive crude slate to minimise their production of high sulfur fuel oil, and also those shippers who haven't installed a scrubber who will have to run more expensive distillate-based fuels.